Let's turn, though, to Treasuries. They are gaining today despite the U.S. downgrade. This is ahead of tomorrow's Fed meeting and after Japan's finance minister says U.S. bonds remain attractive. Well, for more on the markets, let's welcome Jim Caron. He is the global head of interest rate strategy at Morgan Stanley. He's coming to us from his office in New York. Jim, good to see you again here on Fast Forward. Are you surprised with how calm the Treasury markets seem today?
Well, I wouldn't necessarily say surprised. What we didn't know over the weekend was just how the markets would actually take the downgrade information. And where we were most concerned, we're going to be in the funding markets and in the financing markets. So one of the great unknowns over the weekend was just to see how U.S. Treasury collateral was going to be valued in the repo markets. And why that's so important to us is that that's basically where the fundamental cost of money actually comes from, the cost of money and the cost of leverage in the markets, based on U.S. Treasury collateral lending. So, essentially, the fact that that market has stayed relatively stable at the open, that today that things are relatively calm and stable is actually not a surprise. Actually, it's actually a very good thing.
Well, the Federal Reserve did make some statements, right, about the fact that they would continue to take U.S. Treasuries as collateral and sort of continue to treat it as AAA, that there would be no haircuts applied. But when you talk about the repo market, one thing that, we keep focusing on the S&P downgrade, but that was a long-term debt rating that was downgraded. The short-term debt rating stayed the same. It's still the top rating. If that were to get downgraded, and they're not suggesting that at this point, how would that impact the markets?
Well, it's very difficult to say. Clearly that would have a bigger impact on certainly the short-term funding markets. But, I really don't think that necessarily, even if the short-term ratings did get downgraded, that it would have changed the haircuts, as you put it, on U.S. Treasury collateral. So, but you're right. S&P did not downgrade the short-term, so things were certainly more stable there.
Hey, Jim, it's Adam. Is the ECB, by effectively intervening in Europe, doing the QE3 job of the Fed for it?
Well, what's interesting is that, much of the downgrade in the U.S. and a lot of the risks that are associated with it actually cycle right back to Europe. So to the extent that, the markets are focused now mainly on, the turmoil and the uncertainties in Europe as a whole. So is ECB doing the job for the Fed? I'd say no. But what I would say is that the downgrade in the U.S. is what precipitated the ECB to probably be a whole lot more supportive of the European bond markets.
Now, is it possible that given the fact that effectively S&P has already said, OK, you're downgraded, we now know what's happening there, that the real risk is in Europe, and that's where we should all be focused?
Well, that's what a lot of people say, right? They would compare the U.S. AAA or the loss of the U.S. AAA to other entities and other sovereigns in Europe, like France, that also has a AAA rating, and then suddenly that becomes more of a more of a game of trying to understand what the ratings actually mean and are the relative ratings correct. But what I would say is that so far what the ECB has done is probably the right steps in terms of looking to buy the bonds. We need that for stability in the European markets, and certainly the U.S. markets are looking for that as well. In fact, one of the reasons why I think that the U.S. equity market and yields are down so much in the U.S. is that we're still focused on Europe.
Jim, tomorrow is a Fed meeting, right? 2:15, we get an important conversation with Ben Bernanke. Anything that he could say that would be encouraging to the markets overall?
Well, what we at Morgan Stanley are telling clients is that, probably tomorrow is not the day where Bernanke is going to come out with any type of a statement that says, here's the new plan, as some people would like to call it, here's QE3. We don't think that's going to happen. But he could hint at the fact that there could be additional measures of accommodation or support. Anything from lowering interest on reserves to issuing a more longer-term statement on keeping interest rates lower for longer, or even shifting some of the duration in the SOMA portfolio to a longer duration mix, which would keep long-term rates also low for an extended period of time. So these are all the hints that we're going to be looking for in tomorrow's meeting. And what we're telling clients is that this is something that we should be watchful of, and certainly if the Fed is accommodative in their language, that could be a good sign for risky assets.
All right, Jim, we have to leave it there. Always appreciate you breaking down the ins and outs of the Treasury market for us. That was Jim Caron, Global Head of Interest Rate Strategy at Morgan Stanley.